typically growth stocks that are exhibiting high growth will tend to carry a premium. That means their valuation will be higher because people are willing to pay today for tomorrow's growth. Growth investing and value investing are actually popular investment strategies, but they are actually very polar opposite in their approaches. However, they do share a common objective, which is to identify and to find fundamentally strong companies for capital appreciation. So it's similar to like martial arts, right? There are many methodologies to martial arts, like your karate, kung fu, and whatnot, but all of them have the same objective to teach discipline and self-defense to its students. So this is quite similar in that sense. Now, many of us have heard of traditional value investing, which was introduced by Benjamin Graham and made popular by perhaps the most successful investor of our time, Warren Buffett, right? So I believe many of us would have heard of traditional value investing, and value investing typically seeks to invest in such strong fundamental companies when they are trading below their intrinsic value or their book value, right? And normally the best opportunity for value investors are during the financial crisis, when markets tend to misprice or undervalue the stocks during those crises. These are the time value investors will bargain hunt. This is their shopping day, right? So main valuation for value investors they use is through intrinsic value. That means they tend to seek out those companies that can generate what we call free cash flow into the future and discount it back to the current. Right? And typically when they buy, they don't just buy when the price is below the intrinsic value, they buy with a big margin of safety, maybe 25% or more. That is their margin of discount. They buy at a very steep discount. And typically they only disfavor stable and mature companies. However, what is the difference between growth investing then? Growth investing is what we teach here at Beyond Insight. While we also seek to look out the same strong financially sound and fundamentally sound companies, we tend to focus more on the future growth potential of this company as the main criteria, right? Companies which are growing faster tend to generate higher than average returns in the market because growth is the main driver for capital appreciation. We have less emphasis on valuation, so this is very unlike traditional value investing. We focus less on valuation and we are willing to pay a premium for these stocks, right? However, I would like to qualify that we don't pay excessive premium. In Beyond Insight, we have a price forecast model, which we teach our students on how to value these stocks well, so that we pay a fair price, not an excessive price for these companies. Right. Most of the time, when we talk about growth stocks, right, we think about small companies that are growing and they are not so stable yet. However, in the US market itself, where we normally invest, there are many big companies that are still showing very high growth in the double digits. Companies like Microsoft, Amazon, or even Google, they are still showing very high growth despite its size. So we still can invest in strong, mature companies, but they're still growing companies. Yeah, I would like to qualify that value investors doesn't mean that they don't like growth. Yeah, Warren Buffett once said that growth and value are part of the same equation. The main difference is that how much they are willing to pay today for the potential growth in the future. Typically, value investors are not willing to pay a lot for that. Growth investors, much more. The idea is that their growth eventually will catch up with the valuation one day. So that's why investors and traders are willing to pay a higher premium for them.